In 1945, the United States emerged from World War II as the undisputed economic center of the world. Its factories produced over half of global manufacturing output. Its currency became the backbone of international trade. Its creditors became its debtors. The dollar didn't just represent American money. It represented American power. But power, when taken for granted, has a way of slipping away quietly. Not through invasion, not through defeat, but through numbers that look harmless, till they don't. For decades after the war, the U.S. ran trade surpluses, built infrastructure, and expanded the middle class. Manufacturing towns flourished. Wages rose alongside productivity. Debt existed, but it was manageable. America made things, and the world paid for them. That balance would not last. In 1971, a quiet decision changed the global financial system forever. The United States ended the gold standard. From that moment on, the dollar was backed not by metal, but by confidence. Confidence in American stability. Confidence in American productivity. Confidence that America would always be able to pay its bills. That confidence became the foundation of a new era. Without the constraint of gold, borrowing became easier. Deficits became normal. Debt became political. Consumption replaced production as the engine of growth. Why manufacture domestically when imports were cheaper? Why save when credit was abundant? I invest in factories when finance offered faster returns. Each choice made sense on its own. Together, they rewrote the economy. Manufacturing moved offshore. Supply chains stretched across oceans. Industrial skills faded from entire regions. America didn't stop consuming, it simply stopped producing enough to pay for it. The result was persistent trade deficits year after year. Not millions, not billions, but trillions. Here's how the system worked. Americans bought foreign goods. Dollars flowed overseas. Those dollars didn't stay abroad. They came back as purchases of U.S. government debt, treasury bonds, assets, claims on future American income. The world financed American consumption. America financed its deficits with promises. This wasn't generosity, it was leverage. As debt grew, interest payments grew with it. What was once a minor budget item became a dominant one. Every dollar spent on interest was a dollar not spent on infrastructure, education, or innovation. Debt stopped being a tool. It became a burden. History has seen this pattern before. Empires don't collapse when they lose battles. They collapse when maintaining power costs more than it produces. When borrowing replaces growth, when financial engineering replaces real output, when confidence outruns fundamentals, Rome debased its currency. Britain lost its industrial edge. Each believed its dominance was permanent. None were immune. The ticking clock is not a metaphor. It is measurable in balance sheets, in trade flows, in debt auctions that grow larger every year. For most of the 20th century, time worked in America's favor. Population growth expanded the workforce. Technological leadership boosted productivity. Global competitors lay in ruins or struggled to catch up. But time is no longer an ally by default. Demographics are shifting. Productivity growth has slowed. Competitors are no longer rebuilding, they are advancing. And unlike earlier periods of American dominance, the margin for error has narrowed dramatically. One of the most misunderstood aspects of economic power is that it is not static, it must be continuously renewed. Factories age, skills depreciate. Infrastructure decays. A nation that assumes yesterday's advantages will automatically persist tomorrow is making a dangerous bet. The United States has been making that bet for decades. Consider the structure of the modern American economy. Consumption accounts for nearly 70% of GDP. Household spending is the primary driver of growth. At first glance, this appears to be strength. A large consumer base signals demand. Demand attracts investment. But demand divorced from domestic production creates fragility. When consumption outpaces production, the gap must be filled somehow. In America's case, it has been filled by imports and debt. This arrangement works until it doesn't. In earlier eras, trade deficits were temporary phenomena. They appeared during wars, recessions, or rebuilding phases. They disappeared when growth resumed. What makes the modern American deficit different is its permanence. Year after year, expansion or recession, boom or crisis. The deficit persists. This permanence signals a structural imbalance rather than a cyclical one. Structural imbalances are dangerous because they are self-reinforcing. A strong dollar encourages imports. Imports suppress domestic production. Weaker production widens the trade deficit. The deficit strengthens the dollar further as foreign capital flows in. This loop is elegant in theory. It is destructive in practice. 8. Breaking it requires deliberate intervention. An intervention is politically costly. Political systems tend to reward short-term comfort over long-term resilience. Consumers prefer cheap goods. Corporations prefer global supply chains. Governments prefer borrowing to taxing. No single actor intends to hollow out the economy. Yet collectively, that is exactly what happens. Economic decline is rarely the result of a single catastrophic decision. It emerges from 1,000 incentives pointing in the wrong direction. This is why historical comparisons matter. Not because history repeats perfectly, but because incentives repeat relentlessly. Rome did not debase its currency because it wanted to destroy its economy. It did so because raising taxes was unpopular and military spending was unavoidable. Britain did not surrender its industrial leadership intentionally. It simply failed to modernize fast enough, while capital chased overseas returns. In both cases, decline arrived disguised as pragmatism. America's version of pragmatism took the form of financialization. As manufacturing margins narrowed, finance expanded. As factories closed, asset markets soared. Wealth increasingly came from ownership rather than production. Stocks, bonds, real estate. These instruments generate returns, but they do not substitute for industrial capacity. A nation cannot hedge fund its way to long-term strength. Financialization creates the illusion of prosperity. Asset prices rise. Paper wealth expands. Consumption continues. But beneath the surface, productive capacity erodes. The economy becomes more sensitive to interest rates, asset bubbles, and external shocks. Resilience declines even as nominal wealth grows. This is how economies become brittle. Brittle systems perform well under ideal conditions. They fail catastrophically under stress. The COVID-19 pandemic exposed this brittleness. Supply chains snapped. Critical goods were unavailable. Production concentrated abroad became a national security issue overnight. Suddenly, efficiency no longer looked like wisdom. Yet once the crisis passed, the underlying incentives returned. True reindustrialization is difficult. It requires patience. It requires investment with delayed returns. It requires rebuilding skills that were allowed to disappear. Most importantly, it requires accepting higher costs in the short term for stability in the long term. This is where many reform efforts stall. Rebuilding industry means confronting uncomfortable trade-offs. Higher prices for consumers, lower margins for corporations, greater discipline in fiscal policy. These are not popular messages. They do not win elections easily. They do not trend on social media. But history is indifferent to popularity. Another challenge lies in the globalized nature of modern production. Supply chains are no longer national, they are planetary. Rebuilding domestic capacity means untangling decades of offshoring decisions. It means confronting powerful interests that benefit from the status quo. And it means navigating retaliation from trade partners who have built their growth models around American demand. This is not a simple policy shift. It is a structural transformation. Meanwhile, competitors are not standing still. China has spent decades methodically building industrial depth. It began with low-cost manufacturing. It moved into electronics, then machinery, now advanced technologies. Each stage built on the previous one. This is what industrial strategy looks like. Not slogans, not announcements, but sustained execution. Other nations followed similar paths. South Korea, Taiwan, Germany, all maintained strong manufacturing bases despite rising incomes. They invested in skills. They protected industrial ecosystems. They treated production as a strategic asset. The United States largely did not. Instead, American policy increasingly treated manufacturing as expendable. The assumption was that innovation alone would suffice, that design, branding, and finance could replace production, that making things was less important than owning ideas. This assumption underestimated the importance of tacit knowledge.
Karate.
You cannot innovate in isolation from production indefinitely. Manufacturing is not just about output. It is about learning. Every factory is a laboratory. Every production run generates data. Every failure improves process knowledge. When production moves abroad, learning follows. Over time, innovation migrates as well. This is why industrial decline is so difficult to reverse once advanced. The loss of manufacturing also weakens labor markets. Industrial jobs historically provided upward mobility without requiring elite credentials. They anchored communities. They supported families. They created social stability. Their disappearance left gaps that service sector employment has not fully filled. The result is polarization, economic and political. Economic insecurity breeds distrust. Distrust erodes institutions. When large segments of the population feel excluded from growth, social cohesion weakens. This is not an abstract concern. It is visible in declining trust, rising extremism, and political paralysis. Economic systems that fail to deliver shared prosperity eventually undermine themselves. At the same time, the fiscal situation grows more constrained. Debt servicing absorbs increasing resources. As interest rates normalize, the cost of maintaining existing obligations rises. This limits policy flexibility. Every crisis becomes harder to respond to than the last. The margin for error narrows further. Historically, empires decline when they lose the ability to adapt. Not because adaptation is impossible, but because it threatens entrenched interests. Those benefiting from the existing order resist change. Delay accumulates. Eventually options disappear. Yet it would be a mistake to conclude that decline is inevitable. History also shows that reversals are possible. History require clarity, coordination, and courage. They require acknowledging trade-offs rather than denying them. They require acting before crisis removes choice. The United States still possesses extraordinary strengths. World-class universities, deep capital markets, technological leadership, abundant natural resources. These advantages have not vanished. But advantages unused eventually become irrelevant. Potential must be converted into capacity. The choice ahead is not between decline and perfection. It is between managed transition and unmanaged decay. Between proactive restructuring and reactive collapse. Between shaping outcomes and being shaped by them. This is the real meaning of the ticking clock. If America chooses the harder path, the rewards will not be immediate. Growth may slow before it stabilizes. Prices may rise before resilience improves. Political conflict may intensify before consensus forms. But the alternative is worse. The alternative is continued drift until adjustment is forced under crisis conditions. History suggests that forced adjustments are far more painful. Empires rarely fall in moments of self-awareness. They fall when denial outlasts opportunity. When leaders mistake inertia for stability. When citizens mistake consumption for prosperity. By the time collapse becomes obvious, it is usually irreversible. The most dangerous belief is not pessimism. It is complacency. The belief that it can't happen here. Every empire believed that. Everyone was wrong. The United States is not condemned by fate, but it is constrained by arithmetic. Debt compounds, deficits accumulate, industrial capacity erodes quietly. Ignoring these forces does not neutralize them, it accelerates them. The clock continues to tick. Each year of inaction narrows the range of possible futures. Each delay increases the cost of correction. The question is not whether America will change. The question is whether it will choose to change or be forced to. History has already written the outline. Only the ending remains uncertain, and that ending will be decided not by speeches or slogans, but by whether production once again matters as much as consumption. Whether long-term strength is valued over short-term comfort, whether the lessons of past empires are finally taken seriously, because in the end, economic power is not declared. It is built and rebuilt, or lost, silently, one decision at a time.